Hi, everyone. It's Austin from Westwood again, and tax season has finally wound down to a whimper. Our tax forms or extensions have been filed, Uncle Sam's pockets are teeming with cash, and hopefully a good number of our listeners are awaiting a healthy refund amount, or they at least managed to break even for the 2022 tax year. And while we should all be enjoying a shared sense of relief and accomplishment on the tax side of life, things still look and feel a bit grim in the financial world. There's still plenty of talk about recession, like will it happen or when will it happen? Companies like Meta and Twitter and even Yankee Candle have laid off at least 10% of their respective workforces since January of this year. And the stock market has been volatile, to say the least. But we here at Westwood believe it is better to light a candle than curse the darkness, and that's why we're going to talk today about how lifetime gifting can be an effective way to transfer wealth even when financial times are tough. So, with that being said, let's get right into it. So, what is gifting? Well, in order to explain gifting, we have to discuss property ownership. And the best way to discuss property ownership, as any law student or attorney will tell you, is to talk about sticks. Yes, in year one of law school, every law student in the United States is introduced to the idea that the right to any kind of property is like holding on to a bundle of sticks. The idea being that property ownership is not a single unified concept, but rather an aggregate assembly of different rights and duties. Each stick represents a different right or duty, like the right to use and enjoy your lake house, or the right to receive royalty payments from an oil company drilling on your family's mineral lease. In some cases, you may only hold on to some of the sticks, like a tenant in an apartment who can live in the apartment for the rental term, but cannot sell that apartment to somebody else. Or in other cases, you may hold all of the sticks, like that hot pink Gibson Flying V guitar collecting dust underneath your bed, which you could set on fire Jimi Hendrix style if you felt so inclined. Once law students have mastered the concept of sticks, the next thing they are taught is that one of those sticks represents the owner's right to dispose of or give away the entire asset or some portion of that asset, hence gifting. The stick analogy is still helpful here because you need to actually be holding the gifting stick in order to actually have something to give. Using the prior comparisons we just walked through, a tenant simply cannot give their apartment away because your average tenant's bundle of sticks does not include the power to dispose of or give away the apartment that's being rented. But you could certainly dust off that hot pink Gibson Flying V guitar I mentioned and give it away free and clear to your neighbor in the apartment next door. But lawyers being lawyers, we don't want to speak in sticks all the time. We tend to want to put things a little bit more eloquently. So here, a more appropriate definition of a gift is basically a voluntary conveyance of land or a transfer of goods from one person to another made gratuitously and not upon any consideration of blood or money. There's a tip of the hat and a thank you very much to Black's Law Dictionary, second edition. What this all means is that a gift is essentially a voluntary and immediate transfer of an entire asset or some portion of that asset, that is, some or all of the sticks, from one person, that is the donor or the grantor, to another, who is the donee or the grantee, without consideration. And consideration is really just fancy lawyer talk for something of value given in exchange for something else of value, kind of like a trade. It's also the bane of the semester of contracts that is mandatory for all first-year law students. And fortunately for us, today's discussion is dedicated to gifting and not to defining the element of consideration under contract law. So let's move on. And in order to determine whether a gift was in fact actually made, you, in essence, have to establish the existence of three basic elements. The first one being, did the donor intend to give the sticks to the donee? The second one, did the donor deliver the sticks to the donee? And the third one, did the donee accept the sticks from the donor? And assuming all three of these elements are met, then it is reasonable to conclude that a gift has in fact been made from the donor to the donee. So, why are we talking about the transfer of sticks from one person to another? Well, this may come as a surprise, but it's because the IRS wants to know the value of any sticks that are being given from one party to another. And if the value of any gifted sticks exceeds a certain dollar amount, then the IRS will assess a gift tax against such a transfer usually to be paid by the donor, not the donee, but there are special circumstances where the donee may agree to pay any assessed gift taxes. That's right. There is such a thing as a federal gift tax. And while we all worry about income taxes every year, and we hear some politicians about every 4 years or so sermonizing about the estate tax or the death tax, which it's sometimes called, we rarely, if ever, hear anything about the gift tax, and we hear even less about the generation skipping transfer tax. That is, of course, until today's discussion. And while I would love for each and every one of our listeners to be absolute experts on the ins and outs and the ups and downs of the federal gift tax and the generation skipping transfer tax, which I'm going to call the GST tax, the unfortunate truth is that taking a deep dive into these two taxation systems is way beyond the outer limits of today's discussion, but we will cover a few of the high points as they apply to the transfer of wealth during a donor's lifetime. Let's take a quick stroll down memory lane. The federal gift tax has actually been around for quite a while. It was first enacted in 1924, so happy early 100th birthday to the federal gift tax, only to be repealed in 1926, and then was thereafter overhauled and reintroduced in 1932, and since then it has more or less continued chugging along with nowhere near the same amount of scrutiny as the income tax or the estate tax. It should also be noted that the stated purpose of introducing the gift tax in the first place was to assist in the collection of the income and estate taxes and prevent their avoidance through the splitting of estates during the lifetime of a taxpayer. Basically, why should my $100 million estate be taxed if I can successfully transfer $99 million to my children and then kick the bucket the very next day? In the absence of a system for taxing gifts, wealth transfers like this during a donor's life could essentially occur in perpetuity while drastically decreasing any potential exposure to estates and income taxation. That may be a win for the wealthy deathbed donor and the donor's family, but that's potentially a huge loss for the IRS. Now, the GST tax is only about half as old as the gift tax, and it was not even introduced until 1976. So I guess happy early 50th birthday to the GST tax. And it seeks to assess tax on transfers either made during a donor's lifetime or a bequest upon the death of a transferring decedent that are made directly to grandchildren or more remote lineal descendants, which are characterized as skip persons for GST tax purposes. The GST tax effectively imposes a separate tax that is in addition to any assessed gift tax during a donor's life or an estate tax upon the death of a decedent on any transfers of wealth to recipients who are 2 or more generations younger than the donor or the transferring decedent. We're going to keep our conversation about the GST tax as brief as possible, given it is almost a superhuman level of complexity. But I at least want to introduce it for today's discussion because we hear about it so little compared to the income tax and the estate tax, and yet it still lurks in the shadows of any potential gifting strategies, depending on who will be the ultimate recipient of any proposed gifts. Again, bundle of sticks. So now that we have the history part down, how does gifting work in our modern context? Well, basically, the Internal Revenue Code gives you a lifetime exemption of $12.92 million per donor in 2023. But to put it another way, we can each transfer in 2023 $12.92 million worth of sticks during our lifetime completely tax-free. And please note that this $12.92 million exemption amount is the exact same amount that applies to the federal estate tax and is interrelated with the federal estate tax. That is, taxable gifts that are made during a donor's lifetime will reduce the remaining exemption amount available upon that donor's death to be used to reduce or altogether avoid any estate taxes being due. So to put that concept another way, the more taxable gifts you make during your lifetime, the greater the risk that your estate will incur an estate tax due to all of the exemption amount you use to make tax-free gifts during your lifetime. Any lifetime gifts made beyond that $12.92 million exemption amount will result in a gift tax being due by the donor, in most cases, at a tax rate of 40%, which is coincidentally the same tax rate as the estate tax. However, each year, donors are permitted an additional tax-free amount, which is called the annual exclusion. And for 2023, that annual exclusion amount is equal to $17,000, which is completely disregarded for gift and estate tax purposes. So that means that in 2023, a married couple with three children could transfer a total amount of $102,000. That is, mom could transfer three separate $17,000 amounts to each child, and dad could do the same without owing any gift tax or reducing their respective lifetime exemptions. Because I get this question a lot, I should point out that any gifts received by the donee will not result in any taxable income that needs to be reported by the donee in the year the gift was made. So, to synthesize everything we've discussed so far into the simplest terms possible, the federal gift tax only applies to transfers of stick bundles made while a person is living. The federal estate tax only applies to the transfer of stick bundles at death. And both the federal gift tax and the federal estate tax are subject to the same tax rate and share the same lifetime exemption amounts. And the GST tax is an additional tax on a transfer of stick bundles to a recipient or a donee that is two or more generations younger than the donor or the transferring decedent. Okay, so far today, we've talked about property ownership as represented by a bundle of sticks, and we've also covered the ways in which the IRS can tax certain transfers of stick bundles, the value of which exceeds specific valuation thresholds. So what does all of this information mean to you, and how can this information be strategically deployed as a part of your financial and estate plan? Well, simply put, making taxable lifetime gifts to family members and other loved ones can be an advantageous wealth transfer technique because it ultimately allows you, the donor, during your lifetime to reduce the value of your estate upon your date of death so that your estate incurs a tactically reduced or altogether avoided estate tax at your death. Assuming the donor's goal is to implement as many legitimate planning techniques as possible in order to minimize the payment of any of these taxes, then electing a proactive approach to identifying lifetime wealth transfer opportunities may yield the following benefits. Number one, as we just discussed, each donor and each year can take advantage of the annual exclusion by making gifts less than or equal to the annual exclusion amount for a particular year. And again, the annual exclusion amount for 2023 is $17,000 without triggering any gift tax or using any of your lifetime gift tax exemption. Number two, making more lifetime taxable gifts now means a smaller estate tax value at death, which means your beneficiaries will, in all likelihood, receive more value from an asset that is transferred now, rather than receiving the net amount of your estate's asset value after the payment of the estate tax at your death. Number three, lifetime gifting can also provide non-tax benefits in the form of emotional fulfillment, because the donor is able to see with their own eyes the benefits conferred to the donor's family and other loved ones upon the receipt of such lifetime gifts. That being said, every benefit comes with a corresponding trade-off, and making taxable lifetime gifts to family members and other loved ones has potential disadvantages as well. One being, gifting assets during your lifetime will mean that the donor no longer has control over the gifted assets, which may have ramifications to the donor in the future based on the donor's own individual needs and a custom standard of living. Two, the donor's goals and priorities may be vastly different than those of the donee, and consequently, the donor may end up giving assets that the donor desires to see protected and preserved, but ultimately wind up in the hands of a donee who is not financially responsible or who may actually squander the gift. Number three, while the lifetime exemption of $12.92 million per donor in 2023 is higher than it has ever been, it is still not an infinite amount, and excessive lifetime gifting made by ultra-high net worth donors will eventually erode the full lifetime exemption amount and begin incurring the payment of gift taxes during the donor's lifetime. Number four, increased lifetime taxable gifting will reduce the amount of assets you can transfer estate tax-free at death. And number five, don't forget about our friend, the GST tax, which is an additional tax to the gift tax and can significantly increase the overall tax burden of transferring assets to future generations. In light of these potential advantages and disadvantages, and taking it all the way back to the gloomy financial atmosphere I mentioned at the top of today's discussion, a market that is volatile or down can be a good time to make taxable gifts and transfer wealth to the next generation, because the value of assets that you want to transfer may be lower than usual. Remember, it all goes back to how many sticks that a donor is willing to transfer to a donee, and the IRS is concerned with the taxable value of the sticks to be transferred. So transferring a lower than usual valued stick bundle now will mean that less of your lifetime exemption will need to be utilized to transfer that bundle of sticks gift tax free compared to the amount of lifetime exemption that would be needed to offset the potential gift tax for making the exact same gift in a much better market valuation wise. And as the value of the stick bundle as eventually returns to its usual value or even in excess of its usual value after the date of the gift, that means that the donor has consequently transferred that resulting appreciation after the fact in value to the donee, which will also be gift tax free. Let's say, for example, that you want to transfer $1 million worth of stock to your children. If the stock is trading at $100 per share during a down market, you can transfer 10,000 shares to your children. But if the stock is trading at $200 per share during a better market, you would only be able to transfer 5,000 shares for the same $1 million gift. If under the 10,000 shares transfer scenario, those $100 per share stocks eventually return to a more stabilized $200 per share amount, or even more, after the date of the gift, then under this example, that would mean that the donor was able to make a $1 million gift and only utilize a corresponding $1 million worth of their lifetime exemption for a gift that subsequently appreciated to $2 million in value after the date of the gift. And even more to the point, free of any additional gift tax ramifications to the donor. What's more, that $1 million gift and resulting appreciation in value is permanently removed from the donor's estate upon the donor's date of death and will not be subject to any potential estate tax ramifications. And while this example is focused on a gift of stock, gifting in a down or volatile market is not limited to just gifts of stock. The same opportunity could exist for other classes of assets, such as real property, family businesses, mineral interests, just to name a few other examples. Of course, there are a few things that all donors should consider before making taxable gifts or transferring wealth to the next generation during a down market. First, you will need to make sure that you have enough assets to meet your own financial needs and goals. This determination can be made by assembling and maintaining a robust financial plan, which we have covered in some of our prior discussions. You don't want to give away too much and put yourself in a precarious financial situation. Second, you also need to consider the amount of your remaining lifetime exemption and the potential tax implications for making any gifts of your property. Depending on the size of the proposed gifts, your remaining lifetime exemption, and the projected value of your estate after the completion of any such gifts, you may still be in a position where gift taxes and/or estate taxes may be incurred. But by partnering with your Westwood advisor and your estate planning attorney, you will be able to analyze various ways to structure your gifts and transfers to reduce or avoid any potential tax impact, such as limiting any gifts to the annual exclusion amount each year, or by transferring your assets to a properly drafted trust. And third, you need to consider the potential non-taxable impact on your beneficiaries. That is, you'll want to consider whether you're giving your beneficiaries too much too soon, or perhaps even creating a sense of entitlement and a corresponding diminished work ethic that could be harmful to any potential beneficiaries in the long run. To recap, if you decide to make taxable gifts or transfer wealth to the next generation during a down market, here are some steps you can take. 1, review your financial situation and make sure you will have enough assets to meet your own needs after any potential gifts have been completed. 2, work with your Westwood advisor, your estate planning attorney, and any other of your financial professionals to ensure that your proposed gifts are structured and transferred in a tax-efficient way. 3, consider leveraging the annual exclusion amount to minimize any potential gift tax ramifications each year that a gift is made to a particular donee. 4, also consider making gifts to trust in lieu of outright gifts to provide your beneficiaries with additional protections from creditors or other potential pitfalls. And 5, talk to your beneficiaries and make sure they understand your goals, your priorities, and the implications of the proposed gifts and transfers. Overall, a down market can present opportunities to transfer wealth to the next generation, but it is important to approach these decisions carefully and with the help of qualified professionals. So that concludes our discussion today, and I want to thank everyone for listening. What goes down must inevitably go back up again, but even in our current market, you can still take a proactive approach and connect with your Westwood advisor and your other planning professionals so that you can identify and implement any potential wealth transfer opportunities for any of your assets that may currently be valued at a lower than usual amount. And keep checking back with Westwood every month while we highlight the planning and investment areas that we think will impact individuals the most. In the meantime, we thank you for your time today, and we hope you enjoy the rest of your week.